welcome to the Commercial Real Estate Show, your source for insightful analysis and enlightening discussions. Hello, I'm Michael Bull, your host. Thanks for being with us today. Thanks for joining us on 42 radio stations, one of them around the country, iTunes, YouTube, or the show website, commercialrealestateshow.com. Well, today we're going to talk about the U.S. office market. The office market's been very interesting around the U.S., and where we sit in Atlanta in our studio, it's been a very interesting market. We've seen the market tighten up. We've seen rents increase more than we've seen in the past. So please welcome my guest. We have Walter Page. He's Director of Research with CoStar Group. Walter, thanks for joining us.
Thank you.
Well, we appreciate it, Walter. So what are you guys seeing for the U.S. Office market overall so far this year? How is it performing?
Exceptionally well. Exceptionally well. Let's run through the numbers here. Office vacancy rates are now down to 11%, so they declined 20 basis points in the quarter and 60 basis points from a year ago. This is the lowest level. We've had 5 years in a row of declining vacancy. We're very close to 2005 levels in terms of occupancy, so we're near peak levels of what we had last time. Rent growth is the fastest of this market cycle. On a nationwide basis, it's 4.3%. A year ago at this time, it was 3.8%. So that's a very solid number if you consider that inflation's running like 1.7%. So that's a very significant increase in rents, and we also have a burn-off of free rent.
Now, that's the increase in the last year?
Last year.
Okay. Wow.
So, and we have markets like San Francisco CBD just keeps plucking along. Year over year is 19%. So it's amazing in some of these markets. Overall, the demand number was exceptional, too. We had 30 million square feet of net absorption in the past quarter, and we've hit a milestone of 101 million square feet over the past year. It's the first time since 2007 that we've hit this number. This would be a rate of demand growth of about 1.4%, which is a pretty good number, but remember the job growth number is closer to 2%, so it could be even more demand growth in the future. In terms of construction, we're at 15 million square feet delivered this past quarter, or half the rate of net absorption. We currently have 128 million square feet underway across the country, so that's up 14% from a year ago. And we have a number of markets, like New York has 14 million square feet underway, 12 million square feet underway in Houston. We have 8 markets that have between 4 and 8 million square feet underway, and we have 12 metros across the country between 1 and 4 million square feet. So roughly half the markets in the country have a significant level of new construction now.
Well, it sounds like from what you're saying, it's really time to build more new supply.
When we've looked at the numbers, we actually see that the vacancy rates for the newer buildings, those built since 2008, and actually even since 2000, have a vacancy rate that is below the national average. This normally doesn't happen because of new construction, but this is an indication that there is a shortage of this new space. It depends on which markets you're in, but it may be a great time to start building office buildings.
And that's interesting, Walter, because I think our listeners that are in the office market, they see it, they feel it, they understand it. But I think our listeners that might be involved in other sectors or just driving down the road because they run a company, they might not realize this office market is this strong because, we keep hearing of companies using less space and people working at home and the job market not increasing fast enough. But from what you're saying with these numbers, boy, we've got plenty of demand.
Plenty of demand, especially for nice space.
Yeah. And what about for maybe spaces that aren't so nice, maybe in the B or C properties? What are you seeing there?
Well, okay, so let's put it in perspective. The demand for nice space, which we would call 4 and 5 star space or Class A space, is growing at 3 times the rate of demand growth for the not so nice space.
Wow.
So we have 2.5% growth in demand for the 4 and 5 star space versus 0.8% growth for the not so nice space. So clearly, this flight to quality is really, really strong. And if you were to compare this back to the prior cycle, the flight to quality is holding on a lot longer, and it is definitely a big trend that we see across the market.
And why do you think that we're seeing that trend?
Well, if you're going to put people into less space per, less office space per square foot that they're allocated to, it's probably better to put them into nice space than into not nice space. So that may be one of the main things. We're also just the way we work today is more collaborative, more open spaces and things like that. And I think that lends itself to also the flight to quality.
Yeah. Well, that makes sense. Yeah, if you're going to use less space, less square footage per employee, maybe you can afford nicer space. And I guess also you've got the job market improving, so nicer space may help you retain and recruit, right?
Absolutely.
And what about central business district versus suburban? What are you seeing there?
So there's been a lot of growth in the CBDs, but people are not really realizing that a lot of growth is also going on in the suburban markets. Some new numbers here. Year to date, we have absorbed 10 million square feet in the CBD markets. That represents an annual rate of absorption of about 0.7%. For comparison, the suburban markets have absorbed 4 times more space than the CBD markets. Wow. And are growing at double the rate of 1.3% rate. So clearly we're seeing strong demand in both CBD and suburban markets. In particular, we find that we call the close-in prime suburban, or the close-in markets like you're in Atlanta, Central Perimeter, or Buckhead would be the markets that people are really gravitating to.
Okay. And so what do you expect moving forward, Walter? It seems like you're bullish on the market. What do you expect, say, for the next year? Okay,
so we expect that vacancy rates, which now are 11%, are likely to decline to the 10.5 to 10.3 range, bottoming out in 2017. So we've got almost 2 years left in occupancy gains across the markets. Now, of course, it depends on which market you're in. The rent growth that's at 4.3% right now, we expect that to moderate going forward, especially in markets with significant construction like Houston. So we're expecting a neighborhood of 2.5 to 3% rent growth for the next few years, still well above inflation. And then pretty much a fairly normal market.
Yeah. Well, it sounds like good news. And are there any trends that you guys are seeing in the numbers or in the way companies are using space that could impact the office performance moving forward?
Well, I mean, the biggest trend that we see is a reduction in space per employee. Reduction in space per employee, we've seen we're at 235 square feet per employee. That's down roughly 10% from where it was 15 years ago. That's a big trend. The other big trend is the open, collaborative workspace, and then the flight to quality.
Yeah. So the 235 square feet per employee, that's for all office properties all around the country on average?
Yes.
Okay. So so what do you expect to see there? Do you expect that to continue to compress?
We expect some further compression, but probably not as much as what we've had. Right. It would be very likely that we could get to, we're forecasting 0.5% per year in further compression.
Okay. And what is the top 5 markets that have improved the most?
In terms of
occupancy and rate growth, you mentioned San Francisco has just been going crazy, right?
San Francisco, first thing, since the recession ended, has been the absolute stellar performing market. We've had over a 70% spike in rents since then. The next one is San Jose, adjacent to, and likely to come up the hills on their tails will be the East Bay going forward. In other markets that we've seen significant positive trends, Denver, CBD, rent growth 9.4% year over year. Seattle, 7.5% rent growth year over year. New York, 5.8%. Miami, 5.4%. So it's a pretty broad base of recovery. The markets that are trailing, however, would be Washington, D.C. and Houston.
Interesting. Well, next I want to ask you about the investment market and see how this great performance is impacting that. So stay with us. We'll have more on the investment market with Walter Page with the CoStar Group. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you by Bull Realty, a great place to do business. RealNex, software for productivity. Xceligent, information for the professionals. And Commercial Search, properties for sale and lease. To access these companies or for additional videos, podcasts, and articles, visit CREshow.com.